estate investments have lost the benefit of indexation, which allowed property owners to adjust their gains for inflation. Finance Secretary clarified to CNBC-TV18 that the tax incidence under capital gains without indexation is lower, will actually benefit a lot of people. So, I mean, a lot of debate and argument around this one, but you just want to play out that soundbite from the Finance Secretary.
What we have tried to do is that inflation in India is fairly predictable in the long run. We have checked that the average rate of growth of the cost inflation index, which is used for capital gains, is about 4.6%. So it's predictable. We know that on average your assets, for tax purposes, see, individual assets may go at different rates, but we use a steady index for tax calculations, which grows at 4.6%. Now, let me give you a numerical example. I don't think anyone would make the case that property will appreciate less than a fixed deposit. That's not why people buy property. They buy property because it appreciates faster. And India is a land-scarce country. Property is bound to appreciate faster than most other assets. So let's say you expect property to appreciate at, let's say, 15% per annum. Take off 4% for inflation. Currently, with a 15% gain, you're taxed on 11%. Because every year you get a 4% knockoff for indexation. On 11% of the growth, you're paying 20% of that. So 2.2 is the tax that you pay. In the new system, you will pay 12.5% of 15%, which comes to 1.87. So it's lower. It's lower at almost any reasonable rate of growth for real estate, and we have calculated this. We have calibrated to be, in fact, for us it will be negative, because in most cases, the tax which would be computed on an indexation basis would have been higher than the tax on the non-indexed but much lower rate that we have imposed. So we've tried to keep it at a level where almost nobody will lose. A lot of people will gain because the indexation benefit will be less than the benefit that they would get. And so, one more thing I want to add. We will continue to start valuing property only from 2001. So it's not as if that benefit is taken away.
That benefit is not taken away?
That is not taken away. The value of the property will be the value as of 2001 or of the date that it was acquired.
Okay, clearing the air on this entire, confusion around real estate taxation. But in effect, I think the announcement yesterday is a positive that came through. The fact that long-term capital gains applicable on real estate has been reduced to 12.5% from 20% earlier. Let's discuss more on this development. Gulam Zia, the Senior Executive Director at Knight Frank India, is with us. We also have Gautham Lokande, who's the partner at KPMG India. Gentlemen, morning to both of you. Gulam, first I want to understand from your end, right? For someone who perhaps owns a property, both a legacy property and is looking to buy a fresh one, what are the implications of the announcements that came yesterday?
Good morning to you all. First of all, I was just looking at the arguments that the Secretary is putting up, and it is all completely revolving around expected gain per annum of about 11% after inflation adjustment, which is actually not possible. Last 3 years, we have seen the property cycle growing up. The annual growth of property prices are still in the range of 7 to 8%, not considering inflation. So there it is. The whole argument that at least he is putting up is something which is, to me, is applicable only if property prices are appreciating 10% plus per annum, which we haven't seen in last so many years. In fact, if you leave aside last 3 years, prior to that, we have seen a free fall in property prices for almost about 9 to 10 years. And that inflation adjusted would be negative. And that is where, while the whole argument that one is putting up has to be seen over a period of time, multiple factors go into it. But then at least looking at this argument that the property price have to go up 10% per annum is not something which cuts ice. At least I haven't seen that happening. So net, most of us believe that in the long run, the gain that you will get out of this new policy will be neutral to what it was earlier. But then we'll have to see case-to-case basis, different arguments. But I think I'm not fully convinced that there is no loss due to change of this regime.
Okay, got that. Gulam, that's very well put actually. So you're saying that the lower tax implication that you will have is only in case of a higher price appreciation of more than 10% on an average. And that is something we haven't seen, but that is mostly the case with metros, right? Across the rest of India, we have seen many areas, tier 2, tier 3 cities where there is more than 10% price appreciation. So in effect, do you think that broadening of the real estate sector is something that could take place, where people, rather than looking at metros because there is no price appreciation, move on to the broader part of the sector?
That's also not true, because price appreciation also is not every year on year 10%. You can't imagine that every 4-5 years you will see 10% price rise. First of all, it is cyclical, which is all of us are aware of. And then, at least your argument right now is that in non-metro cities, price rise is much higher than the metros. Once again, something which I don't fully subscribe to. So you'll have to once again look at it from case to case basis. At least I'm not convinced that the property price growth has to be inflation adjusted in double digits. That, to me at least, is not possible.
Okay. Gulam and Gautham, thank you very much for joining us. Prashant here. Gautham, if I can come to you, what does this mean for new real estate sales? The removal of indexation benefits, Gautham. And from a builder perspective, is it not positive? Because you're basically paying 12.5 as opposed to 20 earlier.
I agree. So I would look at this in two different segments. The impact that a retail property seller would have, and then the corporate side. For retail taxpayers, Gulam has outlined the picture well. I would broadly agree with it. And again, it has to be a case-to-case assessment depending on the nature of the asset, the cycle in which you sort of purchase the asset. And again, if you've managed to beat inflation significantly in terms of the compounded rate, I would believe that you'll be better off. And if not, I think you're definitely not going to be seeing a good benefit because of the tax change. On the corporate side, Prashant, what you mentioned is right, in the sense that a lot of developers are looking at this very positively. If you look at the corporate transaction market today, a lot of exits being planned by promoters to funds and private equity players, particularly in the commercial real estate side. Promoters will be very happy with the reduced tax rate of a 12.5% vis-a-vis a 20% that was there applicable earlier. So that is very positive, and in particular, a lot of players who have been looking at the REIT market, investors in REITs, also get to benefit because of the change, because their period of holding drops from 36 months to 12 months, and they get to enjoy a lower rate of tax if they have held on to the asset for a shorter period of time. Yeah, I think these are the two, I would say, impact areas from a corporate side. Over to you.
Okay, all right. Thanks for that, Gautham. Well, let's go back to Gulam. Gulam, I wanted to understand, we're talking about this resurgence of the real estate cycle in the last, say, 3 to 4 years. Do you have some rough numbers? How much of these purchases that were done in the last few years, say last 4-5 years, were for end use, and how much of that was for investment, if you'll have a rough number?
It's very difficult, but then if you have to just look at back of the envelope kind of trends that are happening, 3 years back, it was more or less all for end use. But after that, as the prices started going up, 5 to 10% kind of a growth, in a few very rare projects, we have seen prices going up above 10-11% as well in last year or so. In such projects, you would see investors also coming in hordes, because they now want to believe that the cycles have turned and the prices will continue to grow in next couple of years. So while that argument is not completely wrong, but then also that it's a very small number of investors who are jumping in. In my view, it is still not more than 15 to 20% of investors vis-a-vis 80 to 85% of end users who are still buying, and that too in very small pockets. When you're talking about some large, a few of those top developers selling huge number of assets, huge number of properties in, say, Gurgaon or South Mumbai, that is where your number of investors may be slightly higher. But on a broader perspective, I don't want to believe that the number of investors would go beyond 15% out of whatever sales happening in last year and a half.
You mentioned Gurgaon, Gulam. What would the number for Gurgaon be? I mean, in terms of investors?
That could perhaps go 25-30% as well, because this is something which is happening just recently. Last year, we have seen some record-breaking transactions where people are actually standing in the queue and buying. This reminds us back of about 15-20 years back of a cycle upside. But again, as I said, it won't be more than 25 to 30% of investors' share in this market.
Okay, earlier you said that the annual returns on property prices on an average have been only 7 to 8%, right? I mean, is this across the board? And what is the time period you're looking at?
Well, as I said, if I would set aside last 3 years, prior to that, we had a bad cycle. In fact, all the way till COVID and even 21. 2021 is when the property cycle started turning around. Prior to that, we had at least 8 to 9 years of a free fall. And inflation adjusted, those days we used to have negative returns on property price appreciation. It's only last 3 years we've started looking at about 7 to 8% average growth across the country, across the markets, urban, rural, tier 2, tier 3. It is still in the range of 7 to 8%. And then you have to also adjust it for the inflation.
Okay. The other thing, according to me, was a very important takeaway from the budget is that the government is now encouraging states to lower stamp duty on property purchases for all. They've also considered offering a lower stamp duty for properties purchased by women particularly. Now, Gulam, we've talked about this, I think, for the last 10 years, right? The fact that higher stamp duty rates is one of the key reasons for home prices going up so much. So your thoughts on are we looking at this lower stamp duty becoming a reality? If yes, is this a big positive?
Well, at least when the cycles are going up, stamp duty 1% or 2% here and there really doesn't make much of a difference. I'll make a case here. About immediately after COVID, Maharashtra was the first state to offer stamp duty reduction. And that stamp duty reduction lasted for not more than 7 to 8 months. After that, they have actually taken the stamp duty up. In fact, recently, last year and a half or so, they have added a 1% metro cess. So net, we are paying 6% stamp duty in Maharashtra. And in spite of that, the number of transactions is absolutely path-breaking, historically highs. So the point is that just because stamp duty 1 or 2% here and then tweaking would change the market, I don't completely subscribe to that thought. And that even that 1% reduction for ladies buying an apartment is something existing in Mumbai, in Maharashtra for last 2.5, 3 years. So none of these things are new. What the central government is talking about is broad-basing it to other states as well. And maybe other states where you haven't seen any impact of stamp duty reduction may behave slightly differently than what we have seen in Mumbai. But net, these are again, as I said, this is a state subject. Every state will have to be convinced. And one of those states which will be worried about loss of revenues on account of lesser stamp duties, center will have to think about how do they compensate for that.
All right, Gulam, it's always great speaking with you. Thank you, Gautham. Good to speak with you as well. And we'll continue to discuss some of these aspects in the coming weeks as well. Thank you for joining us here on CNBC TV 18.